So we'll start with tackling questions bit by bit, step by step. In the first question until where we can end for the session. So we'll see how we can cover this as many sessions as possible. So let's get to question one first. Question one first. So question one reads, discuss the rationale for expecting an efficient capital market. And then says, what factor would you look for to differentiate the market efficiency for two alternative stocks? So we're just getting started, right? Section A, question one. So in defining our sorry, in us define what looking at the rationale for an efficient capital market. We first define an efficient capital market. So firstly, we define the efficient capital market. So we're saying an efficient capital market is one where the stock prices fully reflect all the available information. So the rationale behind this is that investors cannot consistently achieve returns that exceed the average market returns on a risk-adjusted basis because the stock prices already incorporate and reflect all information that's relevant for us. So we've tackled the first part of this question, right? We tackled discussing the rationale behind this. Now, what factors now would help you differentiate the market efficiency between two alternative
Sorry, sir.
stocks? Yes. Yes, sir. Yes, sir. Hello. Yes, sir. Go ahead, please. I can't get you clearly. Hello. I really can't get you, sir. Pardon? You're breaking, sir, so I can't get you. You're breaking, so I can't get you clearly. Hello, I'm saying you're breaking, so I can't get you clearly. So we said the rationale behind an efficient capital market is that we first define what the capital market is, right? So in the efficient capital markets, the stock prices will fully reflect all the available information. The rationale behind this is that investors are not able to consistently achieve returns that exceed the average market returns, even if it's on a risk-adjusted basis, because the stock prices already incorporate and reflect all information available. Because stock prices already incorporate and reflect all information available. Are we clear here? Am I audible enough? Can you hear me? Can you hear me? Am I audible enough? So generally, right? So having discussed the rationale behind this, now we need to look at what factors you'd look for to differentiate two alternative stocks. So the factors we're now going to be looking at in differentiating these two alternative stocks, you'll be looking at things like, firstly, your liquidity basis. You'll be looking at this from a liquidity point of view. So a liquidity point of view. So what do we say under the liquidity point of view? We're saying that stocks with higher trading volumes and more active markets tend to be more efficient generally because the prices will adjust quickly to new information because of the higher trading volumes and the activity of the markets. That's the liquidity basis. Now, what other factors will help determine the difference? The information availability. So, stocks of companies with high levels of public disclosure, right? For instance, the frequent financial reports are more likely to be efficient be efficiently priced. Be efficiently priced. Third factor is the analyst coverage. So, under analyst coverage, right? We have stocks that are widely followed by financial analysts, that are closely followed by financial analysts. These tend to have more efficient pricing due to the continuous scrutiny they're undergoing. Are we clear here, sir? Are there any questions so far? Can I proceed? Are we on the same page? I think network is really terrible on our end side. Network is really bad on our part. Are you able to hear me clearly? Hello, can you hear me?
Yeah, I think from your end we can hear you.
Okay. Just a moment. Yes. Huh? Natasha, I called the stage she's going to join in 15 minutes. 15. So 15 she can join. Or what? Huh? Yeah, there's a test, but then say they'll be on standby first. Okay. Yes, all right. So generally here, right? Generally here, we've covered the analysis coverage part. Now, the other factor that will help us differentiate between these two stocks is the institutional ownership. So stocks with high institutional ownership, right? For instance, the mutual fund and pension fund owned stocks, these usually tend to exhibit high efficiency because the professional investors tend to monitor these stocks closely. The other factor here is the market capitalization. So stocks with a larger capital, right? Capitalization factor are generally more efficient than smaller cap stocks because they are more visible to the public and they are better studied for scrutiny. That's how we tackle the first part of this question, part A. That's how we tackle part A. Now, part B says define and discuss the weak form EMH. What is the weak form EMH? Begin with. When you're looking at EMH, we're dealing with our efficient market hypothesis, right? We have three different types. We have the strong form efficiency, we have the semi-strong efficiency, and we have the weak form efficiency. So this one asks us to define and discuss the weak form efficiency, right? So begin with, the weak form efficiency is a form of efficiency where the current stock prices fully incorporate and reflect all information contained in the past or previous trading data, including things like the historical prices, the returns, and the volume of those stocks. So according to this weak form efficiency, right, investors are unable to consistently achieve superior returns by way of using technical analysis or studying past market patterns, because this information that they're studying has already been factored into the stock prices. And as a result, the price movement are expected to be random and unpredictable based solely on past information. Are we clear here? Are we clear? Are we clear? Here. Are there any questions for me so far? Okay, proceed. Now, having defined it, right? Let's discuss it further. Now, if the markets are way more efficient, then looking at trends, cycles, and patterns in history will offer no advantage in predicting future price movements. And as a result, you cannot use technical trading in evaluating these things, these prices. So, next part of the question asks us to describe two sets of tests that are used to examine this. Namely, we use our autocorrelation test, autocorrelation test. So the autocorrelation test will examine whether stocks are correlated over time. If past returns are able to predict future returns, then the market is said not to be a weak form efficient kind of market. Now, the second test that you have is the Rounds test. The Rounds test. So the Rounds test tends to look at the sequence of price changes and its randomness. So a run will now look at a sequence of increasing or decreasing prices, right? So the number of runs is significantly different from the random expectation. It suggests predictability and efficiency. Now, we've tackled that element here, right? So let's look at the next part of our question. So, next part of the question, part B, says define the aim and quoted tiers on Lucy market. Give an example of a third market stock. Give an example of a third market stock. So, what is the aim? The aim is simply an alternative investment market. Alternative investment market. Alternative investment market. So, generally here, this aim is a sub-market for the Lusaka Stock Exchange, designed to help smaller and growing companies. Okay, the aim itself is a sub-market of London Stock Exchange, right? Of London Stock Exchange, designed to help smaller and growing companies access public capital. It tends to offer more flexible and regulatory environments compared to the main market because it allows these younger or riskier companies to raise funds through public listings with fewer compliance requirements. Now, let's look at the listed tier. The listed tier on the LUCE comprises of companies that meet the full listing requirement, including the minimum capital thresholds, as well as the corporate governance standards, the disclosure obligations, and the track record of performance. So these companies are officially listed to enjoy the benefits of the wider investor access and the greater visibility. So the quoted tier now on LUCE is designed for companies that don't meet the full stringent requirements, the full stringent requirement on listed tier, but they still want their security to be traded publicly. So it allows these smaller companies, as well as startups or those that are still developing their operations, to raise finances while subject to lighter regulatory standards. So a third tier market, now an example of a third market stock is one that refers to trading of an exchange listed company or securities in what you would call over-the-counter market. Over-the-counter market between institutional investors. So for instance, from the Zambian perspective, right, you could look at Zambian breweries shares being traded on the over-the-counter between institutional investors, although they are normally listed on LUCE. Keep in mind, in Zambia, the third market trading is limited, but informal over-the-counter block trades can occur for listed companies like Zambia breweries or, for instance, even Zambia Sugar. They can occur without this changing. Are we okay here? Are we okay here? Are we okay? Questions?
Yes, I will catch up in due course.
Okay. All right. Now, part 2 says briefly define the following terms. Market order. What is a market order? Help me out with this. What is a market order? Give it a try. What is a market order, limit order, short sale, stop loss order? What are these terms? How would you define each of them? In your own words, help me out with this. In your own words, help me out. How would you define a market order, a limit order, short sale, and stop loss order? Okay, let me go ahead and just define it. So a market order is an order to buy or sell a stock immediately at the best available price. At the best available price. An example of this will be buying 100 shares in a company, right? At whatever the current market price is. Now, a limit order would now constitute to be an order to buy or sell stock at a specific price or better. So for instance, setting a buy limit to purchase this company XYZ stock at only $50. At $50, only the price drops below 50. Now, a short sale would then look at selling securities that you don't own because you are betting that the price will decline. So you can buy them back at a lower price. So for instance, assuming you short sell Tesla shares when you expect the stock price to fall for Tesla, in this case. Now, what's the stop loss order? The stop loss order would now be an order placed to sell a stock once it reaches a specific price to limit the investor's loss. So for instance, you set a stop loss order to sell XYZ. If the price falls to $45, you just sell it automatically once it drops to that point. Yes. So with that in question, let's now look at part C. With that in mind, let's look at part C now. Part C says, give an example of an IPO in the primary market in Zambia. Wants to give it a try? Wants to give this one a try? An example of an IPO in Zambian setup? Go ahead, just give it a try.
Hi, what about bonds?
Bonds, no, not really, because bonds are debt securities. An initial public offer is a setup where a company issues out its stocks for the first time on the public market. It issues out its ownership, opens its doors for the first time. So I'll give an example of Zambia, right? Zambia Sugar. It first went public in the year 2007. So an IPO, Zambia Sugars was listed on the Luce in 2007. So during this IPO, Zambia Sugar offered its shares to the public for the very first time, which allowed the company to raise capital directly from investors while providing the investors an opportunity to acquire equity into the company itself. So it expanded its investors base and increased the market visibility. So an IPO now will occur in the primary market. Yes, please go ahead. Yes.
Okay, so just a question around that. If
Yeah.
Are you able to give an example, like let's say this forestry company, but if you don't know the date, like you can't state that it issued its IPO at on a particular date, would that still apply as a valid answer?
Yes, it would apply as valid answer because every company on the So the best option I would look at now for you is that Lucy, right? It's a primary market where you share shares and everything else. So you can use a private company. Let's say you can use a company that already exists. For instance, Prudential Insurance, right? You can say that assuming Prudential wants to now go public, they would issue their shares on the primary market through an IPO. Because an IPO is only carried out in the primary market. So for instance, the guy mentioned Zambia Sugar, right? There was no, you can just say Zambia Sugar without an exact date, but it will still qualify as an answer. Or you can use a private company that already exists as an example if you want to go public. A hypothetical example, of course.
Thank you.
All right, no problem. So the reason why IPOs usually occur is when companies are trying to raise capital, right, for expansion or for the sake of debt repayment, as well as other corporate purposes. So it marks the transition of a company from private to public ownership because it now enables that company to access a larger or broader capital market. Yes. So that's how we execute this part here. Now it says, give an example of a seasoned equity issue in the primary market and discuss which involve greater risk to the buyer. So for this one now, right? An example of a seasoned equity issue would, so a seasoned equity issue, right, will occur when a company that's already listed issues additional shares. They issue more shares to raise more capital. they issue more shares to raise more capital. So for instance, a good example of this is Zanaco. At some point, some time back, Zanaco sort of issued, Zanaco wanted to undertake a rights issue, public offering for additional shares after the IPO to fund expansion or strengthen its capital base. So generally, this particular seasonal equity issue only happens when you're trying to now issue more shares to raise more capital. You're trying to raise more capital generally for you, in this case, as a company. So Zanago actually did that at some point. Now the risk comparison between these two. We're now comparing risk between an IPO and a risk issue, right? Between IPO and the seasonal equity issue. So for an IPO, they have higher risk. Why do they have higher risk? They pose higher risk because for investors, because of the absence of historical trading data. Since the company is going into, since this company is now going into public for the first time, they lack historical trading data. So investors need to rely on company projections as well as market sentiment and other prospectus disclosures, which may not fully capture future performance. So the uncertainty here is high because there's often uncertainty regarding demand and the price accuracy and how the market will value the stock once it starts trading. Are we okay on the IPO risk? Are we okay on the IPO risk? So that's general IPO risk, right? Now, what's the risk of seasoned equity issues? Seasoned equity will pose a risk in terms of it's lower risk. How is it lower risk? It's lower risk because it comes to the company already listed on the stock market or securities exchange, which has a track record of performance financially and all information is available publicly. So there's a trail of historical data already posted for us there. So the result has lower risk. So investors can analyze historical data to assess the company's growth and stability. However, it still has a certain level of risk to it because if the issuance dilutes the existing shareholders, it can signal potential financial distress. So generally, IPOs will carry greater risk because of the lack of information available publicly. And then seasoned equity issues, despite them not being risk-free, they are less speculative. So IPOs are mostly based on speculation, whereas seasoned equity issues are less speculative due to the availability of the historical data and market performance. Are we okay? Any questions so far? Questions?
No, sir.
Okay. Let's now look at this next question here, question G. Question D says, why do most investors hold diversified portfolios? Let's participate in this one. Why do people go for diversified portfolios? I'm just get an answer from everyone. Why do most investors go for diversified portfolios?
Is to spread the risk.
Okay, risk reduction, yes. So diversification will minimize. What kind of risk are you trying to spread here? Thematic or systematic risk?
And systematic risk.
Systematic risk, right? Because it's industry specific, right? They're
Yes.
trying to spread the risk across a wide variety of assets. Okay, what other reason can you diversify?
Maybe could it be the cost reduction?
Not necessarily. Maybe you could say an attempt to optimize returns better.
Yes, maybe an attempt to optimize returns.
Yes, because when you hold a range of assets, right, with different risk return policy profiles, as an investor, you're able to achieve an optimal balance between both risk and expected return. Diversification will then allow you potentially earn better risk-adjusted returns than if you tend to start to invest in a single asset. That's the second reason. The third reason would now be for you to have smoother returns. So diversified portfolios often tend to generate more stable returns over time because negative performance in one segment will often be balanced by the positive aspect in a different segment, while helping protect the portfolio from significant losses. The fourth reason behind diversification is you have more exposure to growth opportunities. So a diversified approach can allow you as an investor to participate freely in various markets and sectors that may outperform at different times because you're now trying to enhance your long-term growth potential. And lastly, you diversify because you're trying to preserve capital preservation. So spreading the investments across different asset classes will help protect your capital against market downturns in any single time frame, in any single asset or investment. Are we okay here? Are we okay? Questions?
Sorry, please just summarize all four of them again. You said to spread risk.
So we do so to yes, to spread risk. Yes, that's risk reduction. Return optimization. So we said, let me write them down. So we said firstly, risk reduction here. Then secondly, return optimization. Thirdly, we do so because we're trying to gain smoother returns. Then number 4 is we have exposure to growth opportunities. Exposure to growth opportunities. And lastly, preservation of capital. Preservation of capital. This is why we diversify. Are we okay so far? Okay, no problem. So now, next part of the question is asking us, it says, so answer this part, right? What is covariance and why is it important in portfolio theory? Why is covariance important? What is it firstly? So firstly, right, covariance is simply a measure that shows us the extent or the degree to which two assets returns are moving together. So generally, when your covariance is positive, it means that your two assets are moving in the same direction. So both increase at the same time and decrease at the same time. Our negative covariance would suggest that they move in opposite directions. So when one increases, the other decreases. Are we okay so far with definition? We okay in definition?
Maybe you may just repeat it, sir.
Sorry. Yes, so covariance is a measure that indicates the degree to which two asset returns move together. So generally, a positive covariance would signify that two assets are moving in the same direction. So when this asset returns increase, the other one does the same thing. When it decreases, the same thing. Well, a negative covariance would suggest that they move in opposite directions. So when one increases, the other decreases. Are we okay there? Are we okay there? Are we good to go? Are we good to go?
Yes, sir.
Okay. So generally now, based on this, what's the importance of covariance in portfolio theory? So covariance helps us in our diversification effect. Our diversification effect. Diversification effect. How does it help us in this, right? So covariance will play a crucial role in diversification because if two assets have a negative covariance, combining these two assets will reduce the overall risk because if one asset loses, the other one will gain. So the gains may offset the losses. But on the other hand, if the assets have positive covariance, if they increase, it increases your overall return. But then if they reduce, you are faced with the higher portfolio risk if you have positive covariance assets. Are we clear here? Okay, the second importance is now termed as the efficient frontier construction. So covariance is essential in trying to compute a portfolio's total risk or variance or standard deviation, the measure of risk. So by selecting the combination of assets with different covariances, investors are able to construct portfolios that offer maximum expected return for a given level of risk. So these portfolios form the efficient frontier according to the modern portfolio theory. And also, the covariance helps us in our correlation insight. So covariance helps us assess the relationship between assets, which tends to offer insights into whether a portfolio is truly diversified or not. And at this point, you get to have what I refer to as perfectly correlated assets. So if assets have a high positive covariance, they are perfectly correlated. So they don't contribute diversification. Now, if they're negative correlated, covariance tends to enhance them. So generally, based on the same point, assuming you have assets AB, right? AB, covariance is 0.8. AC, covariance is 0.6. And then AD, covariance is 0.2. Which assets is best, which asset class or which portfolio is the best one for diversification here in these three? Give it a try.
0.2, sir.
0.2. Why do you say that?
Yeah, because I think the degree to which the assets are moving together is lower.
Exactly. So there's a higher potential for diversification at this point now. So the lower the covariance, the higher the potential of diversification. Are we all clear here? Yes, please go ahead.
So what is the difference between covariance and correlation?
So correlation just signifies how well they're moving together. So this can be correlation. Now the covariance now signify if they're moving positively or negatively. So they actually work hand in hand.
Okay.
Yes.
Okay.
Yes. Are we okay so far?
Yes, thank you.
Any questions? Mr. Chiwanza, are you okay?
Yeah, I'm fine.
All right. So we covered part D here. Now part E is asking us, explain the shape of the efficient frontier. Explain the shape of the efficient frontier. What is the shape of the efficient frontier first? Our efficient frontier, just a moment. So first of all, we need to know that this frontier is curved, right? It's shaped like this. Our efficient frontier is shaped like this. Shaped like this. It's a curved shape. So upward curved sloping boundary. So represents risk and return. Represents risk and return. So on one axis, you have risk. On the x-axis, you have risk. Here you have your returns here on the y-axis. So as a result, you get to have a curved line, illustrating how risk and return are moving hand in hand in this case. So your efficient frontier will represent a set of optimal portfolios offering the maximum expected return for a given level of risk. So if your portfolios are below the frontier, so generally, right, portfolios below this frontier, portfolios that lie below the frontier here, they are suboptimal. And then these above the frontier are unattainable. Are we okay on that part?
Yeah, you said they are suboptimal.
It's a suboptimal, yes.
So it means anything on the line is obtainable.
Is attainable, yes, it is.
Optimal.
Yes,
Mm.
generally that. So whatever lies on the line is actually performing well in most cases. So now, if we had to illustrate our efficient frontier now, generally, let's see here this moment. So explain what it is here, right? It says now draw a graph that shows what happens to Markovitch efficient frontier when you combine a risk-free asset with an alternative risky asset portfolios on the frontier. Now, for this one, I'm going to illustrate this further in our next class. In our next class we're going to have. How's everyone's schedule tomorrow?
Yeah.
Mine is open. Just depends on time.
Okay, can we have class, let's say 1 p.m. for everyone? Are we in agreement?
So maybe
That's
we at 14.
14, okay. Mr. Chwanza?
Yeah, that's fine, I think, as well.
So, all okay, 14 hours tomorrow?
I think
Yep.
we can.
Oh, okay, so we'll cover the entire paper. Hopefully by tomorrow, Wednesday, we can finish talking about tomorrow. We can cover the last part of this part here, and then also question 2 and 3 tomorrow. Is that okay? In the first session.
Yes.
Alright.
I also just wanted a bit more insight on the frontier, efficient frontier.
Okay, so I'll create a lesson generally based on